Welcome to the InvestSense market commentary for the last week of September 2025 and for the third quarter as a whole. And it was a fitting end to the quarter with markets again up a few percent and what's been a pretty inexorable rise throughout the quarter and especially the last 6 to 8 weeks where markets have just been steadily up and of course led by gold. And there's obviously quite a lot of retail interest there as well. It seems to be a confluence of long-term secular central bank demand and now hedge funds, retail players as well from a more sort of technical standpoint. But the rest of the market sort of up slightly after a little bit of a wobble last week where it looked like the animal spirits were a little bit dented, but most markets pretty steady and Europe up by 1%. Australia actually leading the way. Bit of a bounce, almost 2% up. And if you look at that over the quarter, you can see that it really has been a bit of a rising tide that's lifted all markets. Now, we'll get to that later. Liquidity seems to be the proximate cause. We talked to Andrew Hunt in this week's video about how that, and also how he's coming off the fence a little bit on what might happen in the future. Although, of course, this is not advice and we don't know anything about anyone's individual circumstances or what's in their portfolios, but maybe a little bit of an indication that he's got a few ideas about how the year might end. But what we've seen is yields being relatively well behaved, a little bit of downwards pressure, a little bit back up in the last few weeks as in Australia and also in the US, with the Federal Reserve's preferred measure, the PCE deflator, coming in sort of okay, but a little bit above what they're comfortable with. They've got a 2% inflation target in the US, coming in just below 3%. So most markets up by around 5 to 10%, 15% in the case of gold, Japan up by 10%, the US market and the NASDAQ sort of trading together, which also sort of tells you that the rise has been relatively broad. Emerging markets, especially China, up 10% as well. And Australia and European markets up by about 5%. But actually, the last 3 months, it hasn't floated all boats, this liquidity tide. In actual fact, you've seen the really fizzy stuff that we've put in there. Cathy Wood's ARC Fund, that's always a little bit of an ominous sign when it does really, really well, but up by 15%. But actually, difficult to see in this graph, but right through the middle, you've got the index, that black line, and you can see there's a few above, but most of those growth managers below, which is telling you that there has been this sort of broader feel, but it's not really a style thing. And if you look at active managers, even more bunched. You've got some fund managers, especially those with a lot of financials, very much sort of sector driven, while some of the consumer cyclicals a little bit on the back foot. And if we look at value funds, you can see again a little bit of a bunching there. A gaggle of funds above, especially those that had some financials, and below that, the more defensive type funds lagging a little bit. So again, a sense that investors rewarded for taking on risk rather than being too defensive. And we've seen that across other fund managers that we've talked to in emerging markets and global small companies, very much risk on. Interestingly, though, Platinum, who've been famously defensive and kind of interesting timing, just as they're combined with the L1 group, or pretty much taken over, actually one of their best quarters ever, up by almost 10% and very much keeping up with the Joneses. And if you look at active versus passive, another interesting dynamic, perhaps expected, given if there is a little bit of fizziness in markets, that the passive 70-30 fund has outperformed its active equivalent. But it's interesting that up until the beginning of the last quarter, they'd actually been lockstep, so there wasn't much difference between the typical positions that your average active asset allocator is taking, for instance, being underweight US equities, maybe having a little bit less duration. Those are the kind of things we've noticed over the past few years. But that gap seemed to really broaden in the last 3 months. Now, not really a plug, but in our case, it hasn't really been the same. And so we're a little bit interested in what it is that's happening within the active asset allocation universe that's caused that divergence. We suspect it's going to be something to do with being more defensive. And if you look at the risk return over the last year, you can see it's a straight line. So clearly active asset allocators and the fund managers that they use are being more defensive. And we suspect that that's maybe where this is. Maybe it's the underlying fund management exposures as much as the asset allocation, because as we said, hasn't really been the case for us. So normally we suspect it's just other people like us doing the same thing, but actually a little bit of a difference more recently. But also you have to suspect that most allocators will be underweight things like CBA, but maybe they had a lot more mid-cap and it was small cap that did. Anyway, there's a little bit that we can still unravel and that we'll work on over the next few weeks to get a picture of what's going on there. And maybe at the end of the day, we don't need to complicate things too much. You can see here the trajectory of interest rates in the US over the last year or year to date. And you can see not only has it always been on a downwards path, but especially in the last 3 months. And the gap between long-term rates, 10-year, which is the bold line at the top, and those shorter tenors, 1 year, 3 years and 5 years, and that expectation of lower rates in the US coming out through markets, you can see that that's probably been quite a support. But recently, the last few weeks, if you look at the very right-hand side, you can see that that's just started to edge up and maybe something to keep an eye on. And certainly, if we turn our attention to expected inflation, there's various measures in the US which have shown consumers expecting perhaps higher levels of inflation as tariff impacts come through. This measure is the market impact implied in bond markets, and you can see it's been slowly drifting up, especially over those shorter term tenors, which you can see down at the bottom. And that certainly ties in with the conversation that we had with Andrew Hunt this week. Now, regular listeners will remember that a few months ago, he was talking about this knife edge equilibrium between a more recessionary, deflationary scenario and something more inflationary. And he's definitely coming out on the latter. That was something that we talked about a few weeks ago. He was starting to climb off the fence. I think this conversation, probably a little bit more frank, sees those inflationary pressures, but also a continuation of the liquidity trends. And that it certainly gives you a very different playbook for the rest of this year as opposed to next year. So basically, maybe stay with the benchmark. Again, this isn't advice. It's just what we're reading into this. Not maybe diverging too much. But then next year, you've got a position ahead of that and maybe think about real assets, things that might be more robust if you do start to see more of that inflation. So that's the nature of the conversation we'll probably have with him over the next few weeks. But internally, we're doing a little bit of work around that, things like infrastructure. We've been seeing a few managers there and doing some asset allocation work around that. And we'll spend a bit more time thinking about that, talking about that for the rest of the year, we suspect. Look forward to talking then. Thank you.